Hot picks, we are looking at energy-related names, and our guest has Baker Hughes, the oil and gas services giant, as his top idea. We're joined by Stewart Glickman, analyst at CFRA. Stewart, thanks very much for giving us the time. Give us your thesis on Baker Hughes, if you would.
Hi, Andy. Thanks for having me. So Baker is, prototypically known as one of the big three in oil services. Of course, oilfield services depends on upstream capital spending by the big players in the E&P space, the ConocoPhillips of the world, the Devon Energies of the world, and so on. And oil services right now does not look that great. However, Baker has another avenue going for it, which is its industrial and energy technology business, which is very well levered to two emerging trends or developing trends, if you will, probably through the end of the decade. One being LNG exports, liquefied natural gas, and the second being data center growth. So all those data centers require lots of cooling technology to make sure that everything's working well, turbines to have everything function properly. So Baker has exposure in those areas as well. And right now, Baker's revenue story or profile, if you will, is about 50-50 between traditional oil services on the one hand and this industrial energy technology business on the other hand. The backlog is rising. The margins in IET are really strong. And we think it's going to be a key driver for Baker for the next couple of years.
Wow, I wonder would they be tempted to do some kind of spin-off to, as you know, unbury the value. I forget what the express surface the value in
Unlock
that.
the value?
Yeah, go ahead.
So actually, it's an interesting question. They've actually done kind of the opposite. They have added to that, to their firepower in this area. They recently acquired Chart Industries, which gave them exposure, for example, into industrial energy technology that can be used in the mining industry, to which they did not have any exposure before. So it does look like they're using, they're intentionally diversifying. I think to be fair, the margins in IET are quite strong. So it's helpful to have that on hand, and it probably protects them to some degree if traditional oil services doesn't recover in the way they would like. So having that in your back pocket is probably a plus.
You have an LNG name for us, Cheniere. The LNG is even the ticker symbol, and they're a huge exporter.
Yes, Cheniere Energy, as you mentioned, ticker LNG, is probably the dominant player, the first mover in liquefied natural gas exports. So they are kind of a tolling booth for the industry. They have all the export facilities that will allow natural gas to be cooled, put on an LNG tanker, and shipped overseas to gas-hungry markets like Western Europe or Asia. And I think what Cheniere is benefiting from is that the U.S. is basically the low-cost leader when it comes to pricing for natural gas. Henry Hub, which is the U.S. benchmark, is somewhere in the neighborhood of about $4.50 to $5 per million BTU. If you look at similar benchmarks overseas, in Europe, the TTE is typically around the $11 to $12 per million BTU range. The JKM marker in Asia is in a similar neighborhood, around $12 per million BTU. So it does pay for these buyers overseas to pay for the shipping of that natural gas, move it from the low-cost place, and bring it over to their home markets. And there is certainly plenty of demand from both Asia and Europe. We don't think that's going to be changing anytime soon.
And then finally, Diamondback, another cute stock, ticker symbol FANG, was a Diamondback is a snake. What's the attraction here, Stewart?
Right. So Diamondback is a pure play in the E&P, in the Permian Basin. Permian is the workhorse of U.S. lower 48 oil production. We are not particularly optimistic about oil prices in 2026. They've averaged about $66 a barrel in 2025 through November at least. And for 2026, we're only projecting about $63 a barrel. I think what you have here, though, is you have a consensus expectation on Diamondback and on oil producers in general for 2026 that oil prices are really going to disappoint. The EIA is calling for about $51 a barrel next year. We think that's a bit too pessimistic. And secondly, Diamondback gets about 20 to 25% of their production in the form of natural gas. One of the problems that has been sort of chronic in the Permian Basin in the last several years is not enough takeaway capacity out of the Permian. And so that's weighed on pricing. But just recently, there's been an expansion in that takeaway capacity. There's more to come in 2026, probably through 2028, actually. And what I think this means is that realized pricing for natural gas for pure plays like Diamondback in the Permian, probably not going to be as pessimistic or as lousy as it's been the last couple of years. So we think that improves. And so our estimates for earnings power for Diamondback are better than what the consensus is at right now.
Thank you very much, Stewart. Really appreciate it. Stewart Glickman, analyst at CFRA.